David Stockman, the former White House budget director, as I mentioned, under President Ronald Reagan. He's also the author of the new book, The Great Deformation, The Corruption of Capitalism in America. David, if you wrote this piece to sell more books, you certainly have done that.
Well, I was trying to summarize a big point, and that is the Main Street wisdom, I believe, is wrong. It's delusional, it's dreaming.
The Main Street wisdom that the Fed...
that everything is fixed, we're getting better.
Okay.
There may be some challenges ahead, but the budget is getting better. The Fed is going to work its way out. I say no. We were at the same point, 1560 on the S&P, 4,750 days ago in March 2000. And in those 13 years, the Main Street economy has gotten worse, deteriorated.
So we're just running in circles, is what you're saying.
And in the interim, we've had 2 crashes.
Okay.
$5 trillion was lost in .com by the household sector. $7 trillion lost in the Lehman meltdown. So the Fed has become a serial bubble machine. All of this massive money printing is not getting out of the canyons of Wall Street. It just becomes money to fund speculation and yo-yo this stock market and risk assets up and down. The fast money makes a killing. This is how the 1% recovers. The 99% are going nowhere. There are actually, and I think it's important to remember, 5 million fewer full-time middle-class jobs today in 2013 than there were in March 2000, the first time we crossed or hit near the 1550.
So there's a structural change going on in our job situation, in our jobs market. But we haven't fully recovered, though, David, yet in the jobs market. We haven't fully created all the jobs that we're supposed to in this recovery. Let me just read for you some of the responses, particularly from Paul KRUGMAN in the New York Times on his blog. And he doesn't hold back either in his criticism. He says, quote, "This is all cranky old man stuff, the kind of thing you get from people who read Investors Business Daily, listen to Rush Limbaugh, and maybe, if they're unusually teched up, get investment advice from Zero Hedge."
Well, that's funny, because Paul KRUGMAN was a nice, astute young man when he worked on the economic staff of the Reagan White House and helped us with the tax cuts.
So you knew him.
And over the last 30 years, something went wrong. I don't know what it was, because that...
Maybe he got religion, and this is where he said... Look, what
maybe he got lost. I would say he got lost.
What he is saying is that he takes he doesn't take it piece by piece, but what he says is that your column, though, your op-ed, is not backed by numbers.
Well, my op-ed has a lot of numbers in it, and my book is 700 pages, by the way, and a huge amount of documentation of how we've been drifting towards fiscal bankruptcy and the total failure of our central bank over the last 20 or 30 years. But just take one number. He wants numbers. In the last time the S&P was at this level, the balance sheet of the Fed was $500 billion. Today, it's $3.2 trillion and rising $100 billion a month, more or less. Now, that's a 6-fold increase in the juice into the Wall Street, into the speculative arena. Where's the real economy gone? Hardly any jobs, 17,000 a month.
David.
So Main Street and Wall Street have been totally divorced. The Fed is a dangerous instrument of speculation.
Okay, you wrote in this New York Times op-ed, I just want to take another quote from it where you talk about the markets. You predict that this latest Wall Street bubble, inflated by an egregious flood of phony money from the Federal Reserve rather than real economic gains, will explode as well. So you say we are in for another big crash.
Yes, we've already had 2 since the last time we were here. The .com crash, the Lehman crash, the housing crash. The real economy is in worse shape every day if you look at whether we're investing, which we're not, if you look whether we're creating jobs, which we're not.
But the real economy is in worse shape than what? The real economy is not in worse shape than we were 4 years ago.
4 years ago, that's the recency bias. You have to look at trend. I'm going back to March 2000, the last time the stock market is where it is today. And in that 13-year period, we barely crept forward. We have created only 17,000 jobs a month when we have 150,000 labor force growth. Investment in business, plant, and equipment up less than 1% a year in real terms. How can an economy survive in the long run if it's not investing in its capacity? Middle class, real, of the 90%, the bottom 90%, real wealth, down 25%. What I'm saying is that...
Which is why the government and the Democrats saying we need to put more money into the economy then.
That's crazy. We're borrowing money and burying the future generations in debt because our economy's failing. The Fed is a bubble machine that only works for the speculators and the traders and the 1%.
So, David, you say the Fed is creating a bubble in equity prices. Would you say they're creating a bubble in bond markets?
Sure. It's the greatest bond bubble in history. It's the most dangerous thing that's ever happened. And not just the Treasury. Look at the junk bond market today. CCC rated debt is now trading under 6%. It's crazy. Nothing like that would have even been remotely thought of 4 or 5 years ago. So we have this huge recency bias. People don't even know anymore that they're heading to the end of the cliff. So I would say...
End of the cliff. Describe that for me. What are you talking about here?
When the bond bubble finally breaks because all the people who were front-running the Fed and buying on repo treasuries to take the spread between 2% on the yield and 10 basis points on their overnight carry, when they get any sense that the Fed is slowing down or going to stop
which is going
buying,
to happen at some point,
there will be a panic selling because no one owns the bond. They're all renting it. It's a big arbitrage. It's the most dangerous thing that any central bank in history has ever done.
But David, the Fed is not going to take their foot off the gas pedal on quantitative easing until the economy is back on more solid footing, until we're really creating jobs. So at that point, the economy will be on better footing. So where do you get your doomsday scenario?
My doomsday scenario is in the bond market. Once the yield starts going up, the price of all of these repoed bonds, these fast money traders, starts falling, they will sell. Who's going to buy? The Fed won't be in a position to buy because it's no longer in the quantitative easing business. The foreign central banks that have been buying all our debt, China and others, are more or less stopping. We have a dangerous situation where of the 12 trillion of Treasury outstanding publicly held, 5 trillion is sequestered in central banks. There wasn't real buyers.
What do you mean it's sequestered in central banks?
It's been bought in by the central banks. The Fed owns 1.8 trillion, the Chinese own 1.2 trillion, Japan, and so on. That means it's not a real market. It has been a market manipulated by central banks. When they stop and you ask real at-risk investors whether they think it's a great deal to own the 10-year at 2%, they will say, H no, okay? Because inflation is 2%.